Jeff is going to do tonight is kind of give the core of his process, his strategy, so on and so forth. So one of the things that I want to do is just kind of go through a very quick background and have you guys at that point turn it over to Jeff, let him go through his stuff, so on and so forth. We will be recording this. It'll be uploaded to our member section probably tomorrow or this weekend, the latest. I know a couple people had a few questions earlier regarding that. And I just a couple of the people have questions here. Basically, we're going to be in lecture mode tonight. So if you do have any questions, you could put questions into the chat box. So this is going to be our agenda tonight. Basically, we're going to give you a very quick intro on who we are. We're going to go through a little intro for Jeff for the people that aren't familiar with Jeff. And basically, he's going to go through three specific things. Knowing more about the product that you trade, how do you find the personality of the price action, and most importantly, really measuring everything out. Everything must be a fact. There is no opinion. Everything must be measured. So Jeff is going to go through a lot of those different details. And the other thing that we're going to do is we have a special announcement regarding some training that'll be coming up that Jeff will be offering via a web series. And we'll talk about it at the very end when Jeff goes through everything. Actually, I'm still waiting for Jeff to log on here. So if you could just bear with me 1 second, I just want to double check, make sure Jeff is good to go, and we should be all set. Jeff, are you there?
Yes, I am.
Oh, fantastic. Okay. All right, everybody, take a deep breath. We're good to go now. I apologize for the technical difficulties. So we'll just keep moving on here. Um, Let me kind of get over to Jeff. Jeff's going to spend about an hour to an hour and a half going through his process. So, Jeff, if you could do me a favor and just give a brief intro about yourself. I know you have a lot of disciples that are on the presentation tonight, and there's a few new people. And then I'll just let you go forward from there. So I'm going to convert. While you go through your intro, I'm going to change the presenter over to you.
Okay. Oh, I must have missed your intro earlier, but I see a lot of familiar folks on here. Let's see. My trading background, I've got about 16, 17 years playing around with these charts and looking at a lot of different chart patterns and all sorts of fun stuff there. Got my start working with a small company out of Seattle that actually kind of started a lot of this seminar type industry when it came to the stock market trading, kind of brought it down to the beginner level, and that was a company out of Seattle, Wade Cook Seminars. Primarily taught a lot of options and things like that, but I learned a lot of technical analysis, and I learned a lot about trading, and actually learned a lot about the students and people that were trading, especially when it came to what the novice were doing. Over the last, let's say, 6-7 years, I've been really focusing on the Fibonacci sequence and just really studying price pattern, price behaviors of the market, watching the different swings, trying to make this fit into my way of thinking and how I process information. Everybody's going to process information a little differently, and some people have an art mindset where they can kind of see these swings and moves and patterns in the market, whereas some of us have a very engineer mindset, and we just don't really play very well with the patterns that don't measure out. We just kind of think that's it's kind of like a little guesswork, so to speak. Okay. Tonight's presentation is going to be pretty much on some of the basics that many people just kind of leave out of their analysis. I want to focus a little bit on price behavior and how to anticipate 2 to 3 swings to the right side of your chart. I also want to kind of profile a product that you're potentially trading, or at least give you some guidelines on how to profile these products. Okay. Let's see. Are we recording this?
Yes.
Okay, great. So do you want me to go ahead and start the presentation, or just is it about 88% of the time we'll get about 80% of the average swing? Okay, so if I'm looking for an 835 point move back up, 80% of that move, let's see if I can type this here, 80% equals about 667 points. So we'll have about an 88% chance that we'll get 667 points out of this move, okay, to the upside. Conversely, taking the 3 swings down and averaging them, we're looking at whatever the swing down would be, which is about, on average, 840 points, okay? 80% of that swing equals approximately 672, okay? So we have an 88% chance that we'll get about 672 points on the swing down, about 667 points on the swing up, based on the last 3 averages, okay? So as we turn the price action back on, we can see how that might have played out. Okay? So as we're looking at these different swings and anticipating them, we can collect pieces of information. Now, the other pieces of information that we can collect off of here would be, let's just identify that. Let's go to the label and let's put the time span on that. So we're looking at 7 days up move off a 60-minute chart on the Dow. Let's see, what's the average here? We have 9 days. Oops. And 7 days. So if you take, well, let's call this about 8 days because it's 7 days and 20 hours, 7 days and 20. So we'll get 8, 16 plus 9. We're looking about, what, 25 divided by 3, which is roughly about 8 days for the move up. Okay. And let's just put our labels on here. Okay, and we did it in a little shorter time. But our expectations are managed by understanding what is the average swing up, how long does it take, the average swing down, how long does it take, and what is the average price swing. Okay, so as we approach and use the information which is currently on our chart to anticipate whether we have a move down or not here, we'll map this swing above and below the 50 moving average. Map the swing down. And the swing back up. Now, I will typically use 3 to 5 swings up and 3 to 5 swings down. Okay? So let's just show the price. It's a little easier to look at there. Okay, so now I have 3 more reference points. 3 reference points here. Let's bring up our calculator. And I have 865 plus 943 plus 972 equals about 2,780 points. Now what I'm measuring is the downswings. I'll take the 2,780 and divide it by 3, which you have about 926 points we're looking for a move down. Okay, so I'll take the 926 and I'll multiply that by 0.20, about 185 points. So what was the last one? 920 something? 926? No, I forgot what it was. Okay, let's just say it was about 929 or something like that. So I'll take the 929 so we're looking on average about 743 point move to the downside. Okay. Now, let's see how far down that is. Label. Okay, somewhere right in that area. Okay. So as we explore, if we have a topping pattern, the next move down, we're looking for 88% of the time, we'll hit about 700 and let's just say 40 points move to the downside based on the last 3 swings on average. Okay. Now I have 1220, 776, and 698. So if I want to look at what would be the next swing to the upside from this point, we could take that same information and start projecting the next 2 swings to the right side of the chart. Now a lot of these pieces of information here are good for you because you know that on a 60-minute chart the average upswing is 7 days. the average downswing, let's just put the number of days on here. Hey, 6 days, let's see, very fast, 12 days, 2 days. So you would take the average number of days to help you manage the expectations of what this move down could potentially be, okay? You may get into looking at the number of bars. You might use some measurements on where the ATR is located. So when you find that average ATR when you have a turning point, you're just adding more things into your pipeline to help you understand the behavior of the price of the product that you are trading. Now, many folks will use a daily chart for a swing trade type deal. Well, here you're looking at a 60-minute chart and you're saying, well, hey, 7 days, 6 days, 5 days, 2 days, and so on and so forth. These are the range we look at for a swing trade based on the understanding of, using the 50 moving average as a mean to find that price behavior, okay? So whereas on a daily chart, when you start mapping out the swings above and below a 50 moving average, you'll find that the duration is much longer in time, okay? And if you're prepared for that, you can your option trades, you'll be buying the right options for the month and strike price, for the anticipation of being in a trade longer than an X amount of days will help you manage your expectations and not get shaken out of a trade. What we're really doing here is we're taking the guesswork out of what we know about price behavior, okay? The chart I want to bring up for another example, oops, wrong one there. And I think let's go to a weekly chart on Caterpillar. Now, as we look at Caterpillar on a weekly chart, you want to give yourself enough time to go back and get some really good pieces of information here. So I've set my first date on this time period back to 1901, so I could collect all the data that is available on Caterpillar. Now, this is a little tedious, but the information is extraordinarily useful when you are anticipating different behaviors in the marketplace. So by understanding these swings and using a mean, like a 50 moving average, to understand these swings and where you have different support and resistance levels, you can use the swings to identify trend lines. You can confirm indicators and oscillators with the peaks and valleys. And one thing that's really important here is somebody with a lot more money change price at these levels, and we need to pay attention when they may decide to do that again. So one of the things that I did this afternoon on Caterpillar here was kind of get some statistics. When I looked at Caterpillar, I went back and drew all the swings above and below the 50 moving average, and I went all the way back to 1976, okay? One of the things that I found is the average downswing was about $12.30. The average upswing was about $17.50. The average downswing lasted about 46 weeks long. Okay. The average upswing lasted about 54 weeks. Okay. The average ATR when we were at the valley, which is the low part of the swing, was about 1.32. The average ATR when we were at a peak was about 1 0.66. Now there's many, many more studies that we could go into in just understanding that price behavior. Okay. We also see that the valleys here, the low point, 7 out of 18 points, 7 times out of 18, October was a low point. We had March also as a low point. Okay. Let's see if I have, where's my notepad there? So some of the things that we're looking at, average number of upswings versus downswing. We had 18 up and 18 down since 1976. The average upswing crossing the 200 and the average downswing crossing the 200 usually had a swing of 31 points on average up, had a swing down of 15 points to the downside. Again, just the average upswing was about $12.30, lasted about 46 weeks. The average downswing, $17.50. Average time, 54 weeks. We saw that on the peaks, 6 of 18, or 30% of the time, May was a high point. About 26% of the time, March was a high point. So when we look at May and March, we can anticipate if Caterpillar is in a nice uptrend, we can start looking for topping patterns if we're at the upper range of the average swing size. On the valleys, we had 7 of 18, 35% happened in October, and 24% happened in March. Okay, so again, we have some reference points. Now, none of this is an opinion. It's factual information. Okay, so when we have facts, we can respond to the information. When we don't have the facts, we tend to be kind of dancing all over the issue, like, well, I think it's gone up too far. I think it's going down too far. And we really don't know. So what we're doing is opening that door for emotions to come in and let those feelings try to navigate your trade. When you start bringing all these pieces of information together, you're going to want to have some parameters for your study. One of the parameters you might want is to have your time frames in which you're comfortable in trading clearly defined. Okay? Now, what I recommend is you have 5 time frames that you consistently reference. So if I take Caterpillar and I go down to a 5-minute chart, because I like to intraday play this one, then I would do the same exercise and get the same statistics. May not go back to 1976 with the 5-minute chart, but I may go back 20 or so swings just to kind of get the beat of what this price is trading at over the last few days or so. Okay, I would understand that on a 5-minute chart, how long does the average upswing last? How long does the average downswing last? How many points are in the average upswing? How many points are in the average downswing? We may even start to take some measurements to identify what is the average time duration from a peak to a peak or valley to valley, and find what is that average. And then we can start measuring in time the average for the next peak or valley. Okay? See, the information is measured. And for traders that have a little too much emotion, the measured patterns or measured structure will take that emotion and suppress it, okay? Because you're approaching the market with a level of knowing now. So since we gave you some information and we said that, hey, October is usually a low point 7 out of 18 times, and we can see that the last move down on the weekly chart that crossed the 50 moving average was a downswing, we should start anticipating and finding out, is there any chart pattern here that would allow me to splice into what potentially will be the next move up. Okay, so on a weekly chart, let's and what would on average the weekly swing up be? Let's see, let's go back. So average upswing is about $12.30. It looks like we've already captured that one there. Okay, just as far as what the average is. But let's go back and look at the average swing size here. Let's take this move up. 95 points. Swing up 26 points. And 29. So let's go find our calculator again. So we're taking the 29 plus 25.90 plus, then we have 95.31 plus 150 points. We're going to divide that by 3 to get the average. And we're going to look at basically about $50 for the average swing up. Okay. Now, 88% of the time, we'll get about 80% of that move. So I'm going to bet on the 80% of that move rather than bet for the full 50. Okay. So let's take the 50 and let's multiply that by 0.20 to find out what the, so we have 10. So we're looking at roughly about a 40-point move up. Okay. So let's take this and we'll look at that projection. Okay. So on the average, the next swing up from a swing size, and we already expect the average upswing and downswing to be playing out, is about 40 points off this weekly chart. We've also discovered that October is generally a low point. Okay. But we need a way to splice in to this existing move. We just don't want to jump in and then risk all the way down. I mean, that's a lot of points on the weekly chart. I mean, current price closed at about $80 and the last low about $66. That's a little too much risk on this time frame. So from the larger time frame, we're anticipating a trend change and a move up. And we're looking for that move up to be the result of about 107 and change here. Now, if I use my fib lines, I want to see, is there anything else at that level? Well, we find that we have the 78.6 about 105, the 88.6 about 110. If we open this up, we can also see that this is the origin of where price had a behavior where it had a nice little exit out of that. So a nice move down from that. So we have a supply level up here as well. Okay. So we have a supply level, we have a projected level, we have a fib level. So we're all kind of congregating around this area as a potential move back up to about the 107 level. Okay. But that still is just information. We have to find a way into this trade. Okay. So as we start looking at our smaller time frames, we went to a weekly chart, so let's go to a daily chart and see if we have a setup to enter in to this particular turning point. This is where we're kind of zoning in and finding what is the pattern that's going to help me splice into this move. Now, we're still going to use the swings above and below the 50 moving average. I'll go back and get like the last couple of swings here. I want to verify why price stopped here by using the prior swing. So I'm going to grab from low to high, above and below the 50 moving average, and I want to find out, okay, well, that's about a 224 extension right in that area. Okay, so if we have a 224 extension, usually price will look for a retrace back up of about 78.6. Okay, so we're looking at a 102 level there. But look, we've closed above the 8 moving average. We still have to risk way too much to get into this trade on this time frame. Okay? So our weekly chart, still trying to make it up this way. Our daily chart, still clearly saying price is moving up. But we don't have an entry yet, or a place where we can plan an entry. So we have to keep going down in our time frame. So let's drop down to like an 89-minute chart. So 89.1 minute. And let's start looking for other ways, smaller time frames to splice into this. Again, we'll use the swings above and below the 50 moving average. Nice little swing up through there. These ones here have very small moves through the 50. I'm looking for something that's going to give me a nice window between price and that 50 moving average. Okay, and this swing did it for me. This swing did not. There was not enough gap between price and the 50 moving average. So I wouldn't use that information on this time frame. This one also qualifies for the same thing as this one. So I'm using the bigger swing here. So by pulling from low to high, see why price stopped down here. Still no real reason for me to get into the trade at this point on this time frame. Okay? But something to point out on this time frame is the swing that goes through the 200 period moving average. We have a swing going down through the 200 period moving average. When we put a measurement on that from high to low, we can see that price is crossing the 50 moving average prior to hitting the 38% retracement of the trend. Well, that's a clue for us. Now, with that clue, we're anticipating maybe a pullback to where we could look for a shape that might come into play as where we might have a double bottom with a higher swing low. That's a common pattern or common shape there, okay, for this time period, okay. But still, it's just information. It didn't allow me to splice into this trade that I'm looking for on the weekly chart. So let's drop down to a 60-minute chart and see if there's any information there to help me get into a trade. 30-minute chart. Okay, here I have a 30-minute chart where I can take the last couple of swings. See, the process is the same on any time frame. Last night I was doing a little bit of study and on the Dow, and it was quite amazing to see the same fractals on a 3-tick, a 5-tick, a 20-tick, a 30-tick, and so on and so forth, making up the patterns of the bigger pattern that we were looking to participate in. So I have a swing up, price comes down, looks like about a 1618 extension there. Okay, so if price hits a 1618 extension, this would be labeled as point A. So now we're getting a little closer to where we might have a setup. The prior swing, X and Y, only because A was labeled a 1618. Let me explain that a little bit. You have an A point if the extension or retracement, how do I want to write this? You have an A point if okay, you have a C point what is that? 0.236, 0.382, 0.50, 0.618 of the prior swing. Okay, so if you have an A point, the prior swing is going to be labeled X and Y. If you have a C point, the prior swing is going to be labeled A and B. Okay, so as we're developing this, if A equals 161.8 extension of the prior swing, which is going to be X and Y, we look for B to equal 0.786, 100, or 113, retrace or extension of the prior swing, which is A or Y to A. Okay, so let's verify this. So we're going to pull the Y to A leg, and we see the price went up and went right to the right in that 113. Okay. Now, some of these, as we're playing, A point needs to be exact, but B point is just a reference point where you're going to go take your profit. Okay. So you have a couple of different levels where your profit is that you can take. And most of the time, my profit on this type of price structure, I'm jumping out at the 78.6. But if you feel price is strong, the market's good, and you want to stay in the trade, your next opportunity to take a profit would be 100. After that, be to 113. Okay, because after the 113, we're looking for a retracement to find point C. Okay, so let's continue growing this chart. We have found our point B, and now we're going to anticipate where point C will come into play. Now C equals 0.382, 0.50, or 0.618 retrace of prior swing, which is going to be labeled A and B. Okay. Also can be same level as X. Okay, so same level as X. Let's go ahead and put a line right around in that area there. Okay, so prior support. As we put our fib levels over here to kind of anticipate that move, we can see where the different levels are we are going to be looking for. That C point. Okay. So once price gets down to C point, I'm just kind of drawing that loosely into that range, we'll have another opportunity to look for price to move back up to finish this structure, where we'll look for our D point. Now this is starting to form potentially the inverse head and shoulders at this point on a 30-minute chart. The D point can be the 224 extension or a 1618 extension. Okay. Now let's bring some of the things we talked about earlier into this equation here. I have a confirmed swing down, let's just put the label on here, of 12 points. I have this swing down above and below the 50 moving average. 15 points. And then I have this swing down of 7, almost 8 points. Okay, so let's just bring our calculator back up. 7.71 plus, and then we'll go 15. And then we'll do 12. So 34.8 divided by 3. So we're looking for, on average, $11.60 move to the downside. Okay. So as we're looking for 1168, we can anticipate whereabouts that retracement level may come into play. Now, if we're looking at 1160 as a price, we can also multiply that by 0.20 to find out what we can take off the 1160, which is $2.32 minus, which is about $9.28. So 88% of the time we should get about 80% of that average swing. So we're looking roughly about this area here, okay, where we have our X point, where we have a 618% retracement. Now, we're bringing a lot of different pieces of information into this projected level to help us anticipate where that best turning point could be. Okay. Now, for the upswing, after we hit this level, we would have to look at the last few swings to the upside. So I have this one at $15, $7, and about the same here. Okay, so let's get our calculator back out. So I'm going to take 6.53, 7.01, 1502, 15.02, $28 divided by 3, 952 is the average upswing. And then let's just find out what 80% of that would be. So times, oh man, I forgot what the number was. Let me do that one more time here. 15.02 plus 7.01 plus 6.53. Let's just multiply that by point. Make it a little easier. I did that wrong again. At any rate, you get the point where we're looking for that next average swing to the upside. Okay. Now we're going to use combination of what the average swing size is, and we're also using Fibonacci retracements, extensions. We'll use things as demand and supply levels. Okay. There's a lot of different techniques that are calling for the same level to be achieved. Now, once it is achieved, we'll look for an opportunity. So on the weekly chart, we're looking to splice into this bigger move to the upside. As we dropped our time frame down to a 30-minute chart, we need to see price come back down into a level of, let's just put a horizontal line here, of about $73 before we have that opportunity to get into it. Okay? So how can we take advantage of going from $80 down to $73 and then play this back up? Well, if you own the stock, this would be a great opportunity to now put a hedge on with a stop loss here. You put the hedge on like maybe writing a covered call. You would then write the covered call at with an option that may be deep in the money, okay? Because you anticipate price coming down to that level. You collect a larger premium because you're not afraid of being called out at that point, okay? Once price has gotten down to this level, or you may even want to just freeze the position by going short a single stock future on this. There's a lot of different ways, different strategies that you can hedge yourself, okay? But one thing we do know is the weekly chart from our statistics and information we gathered for all the way back from 1976 on Caterpillar is that October is generally a low point, okay, where we miss the exact turning point, so we need to splice in and find what that next move up is going to be, because we're looking for this product to go up to that $107 level, right in that range, 106, 107. And there's a lot of opportunity for us to make some money on that larger time frame. But we have to go down to the smaller time frame to find our highest probability entry, okay? So let's break this down even further. Let's go to Caterpillar. And let's go down to maybe a 15-minute chart and see if there's an opportunity for us to splice in to this move down, okay? So using the same information, the same style, we start locating the swings above and below that 50 moving average. It's repetition. We're using the same measurements. We're using the same swings above and below the 50 moving average to anticipate what price behavior may do to the right side of the chart. Okay. So one of the things we're looking for at this moment is where do we have a reversal pattern that would be coming into play. If we're going to play this back down to that $73 level, well, we need to have a pattern to splice into that to do so. Well, the first pattern could be potentially a lower swing high. Okay. If price closes above the 82.19 level, we'll look for opportunities and a topping pattern before we're going to go into this trade for a longer-term trade. Okay, you could keep breaking this down down to a 1 minute, 3 minute, whatever time frame, even tick time frame or tick bars, to find the same fractals or price structure to splice in to what you anticipate the weekly, daily, hourly, all the higher time frames to do. Okay, we arrived at a lot of this information by identifying the swings above and below a 50 moving average. You may find that the 20 moving average or the 34 moving average or 200 moving average fits your style of trading better. Okay? Use all of it as a reference point, but be consistent with it. Okay? For myself, I choose to use the 50 simple moving average in identifying the swings above and below those levels. I find support and resistance at those levels. I find what the average swing up is, what the average swing down is for that time period. I also find out what the duration on average is for the move up versus the move down. We can find seasonal tendencies where we see that October quite often is a low point for Caterpillar. We can see that, May is usually a high point for Caterpillar. And we notice that we have about a 50-50 chance if March is low or high that the market will change directions in March as well. So the information we've gathered helps us anticipate behavior in price by just using the averages. Okay, it helps us exploit those different behavior patterns. Okay. Let me look here. Let me come back to some of the questions that were posted here. It is recorded.
Yep, Jeff. One of the questions was, is it seasonal stock?
Well, what you're discovering by locating the swings above and below the 50 moving average going back further in time as you can, that there are seasonal tendencies. Now, is Caterpillar a seasonal stock? Well, with what we found from 1976 going forward is that 7 out of 18 times October was a low, 6 out of 18 times May was a high. 8 times out of 18 times we found that March was a high or a low. Okay? Now, this is just information again. If we're at a low point in March, we may anticipate a reversal pattern. If we're at a high point in March, we may look at a reversal pattern. Okay? Topping patterns or bottoming pattern. But in May and October, in May, we're definitely looking for topping patterns. In October, we're definitely looking for bottoming or bottom reversal patterns where we can splice into. Okay? So, yes, you can find out if your stock or product that you're looking at is seasonal or not. As you break these down into smaller time frames and you go back further in time, you may find that on Caterpillar, trading a 5-minute chart, that we have peaks and valleys quite often. And those peaks and valleys may be correlated to a time of day that on average we see price change direction. Now, that also may be associated with a gap up or a gap down. It may be associated with an economic report that comes out. We can start matching up that, hey, every time durable goods order comes out, Caterpillar gaps up that morning or Caterpillar gaps down that morning. It has a tendency to gap when that economic report comes out. Okay? Now, having all these detailed pieces of information on a few stocks or indexes can really give you some great trading opportunities as you monitor them. The first few steps of gathering this information is tedious. It's boring. It's a lot of work. But once you know, you have that piece of information that is not a feeling, it is a fact. Okay? You can respond to the information that is a fact. We tend to react to information which is something we feel. Okay? We can use the peaks and valleys to see how consistent RSI is on a 5-minute chart, is on an hourly or a weekly chart. We can find out how consistent the MACD is or any other indicator or oscillator that is visible at the peaks and valleys of these, at the turning points here. Okay? So there's just a lot of information that you can gather from having a mean for your measurement that is very useful information when you're in a trade. The other piece of information that I'd like to point out here is when we were looking at a lot of these swings above and below the 50 moving average on a weekly chart, we noticed when we had swings that were trending that they were longer. Okay? When we had swings where we were turning, the swings were smaller. Okay? So as you gather that information, you can say, well, what is the average swing size on a weekly chart when the market is starting to transition and go short, or transition and go long? Okay? Because each one of these bottoming patterns, or when the market is making its decision to change directions or change trend, we tend to have smaller swings around those turning points. When the market is in a trending mode, we tend to have longer swings, and the retracements are shorter. Okay? Now, the retracement values are a great piece of information as well. So when we're trending, what is the average retracement? How does it compare to the last swings from the turning point? What happens when the average swing size doubles in price? Okay. So when I take the average of the last few swings, let's just use this example over here. So I have a swing up, another swing up, and then I have a small swing up over here. And if I take these three swings and I get the average, and then I notice that this swing over here was double the average swing size, this would be deemed as an impulse wave. Most of the impulse waves that you see are very visible, and you can see them clearly because they're about twice the size of what the average swings were prior to this big move up. Okay? This is all information gathering. As you get comfortable with the information gathering process, you will then start to form the information that you collected into a trading plan to anticipate the next swing and where it may have a turning point. Now, these swings we can use other indicators, other measurements as well to help us with those levels. We may find that this swing up and the pullback, maybe it measured out to a fib level, okay, where we had the 78.6 or the 88.6 giving us a higher low, okay. We may use this information, a chart pattern, to anticipate the swing or anticipate where we might be looking for an impulse wave, okay. But when we look at the reversal patterns, as some of you have seen me do, generally if we have that A point with a retracement of 78 or 88.6 or even further down, that the next swing up tends to be an impulse wave. What makes a trader good is a great understanding of the products that they are trading, okay? Not with feelings, but with factual information. The things that I'm discussing and sharing with you here are greatly what an experienced trader knows, and it might be what an instructor knows, but he knows it so intuitively that it's not often taught. When somebody can walk in and say, yeah, I think the market's going to go down today, and you go, no, it's clearly going up. And then by the end of the day it goes down, you're going, well, what did he see? Well, he may teach you just one technique on what he saw, but what led him into that behavior and to make that comment about whether the price would go up or price would go down? How does a new student gather that information? What does he need to look for? These are the things that I feel is very important for students to look at and get a good understanding. You must do your homework and understand the product in which you are trading, okay? We can use the setups and price patterns to help us splice into the information that we've gathered, okay? There's just so much information we can gather by identifying the swings above and below that 50 moving average, the support resistance, the trend lines. We can put different measurements as far as where we anticipate speed resistance levels to come down to. We can start to triangulate and you put as many things on here as you want, different indicators, oscillators, forward-looking techniques to help us anticipate where the next swing may come into play. Using the average swing size is a forward-looking technique. Support and resistance are forward-looking techniques. Trend lines, forward-looking techniques. MACD, stochastic, RSI, CCI, ATR are indicators and oscillators. It's a totally different measurement, okay? Forward-looking techniques are an essential part of a trader understanding the price behavior, and we need to know the difference. You need to know the difference between your indicators and oscillators as well. There are indicators that indicate where price has turned in the past, and we look for those characteristics, okay? But the information we gather from an indicator is all based off of what has already happened. It is not a forward-looking technique at all. It is a piece of information that is confirmed with existing data. Oscillators are not forward-looking either. They are based off of information that has already happened, okay? But oscillators tend to give us places where we are overbought and oversold. Indicators help us to see changes in momentum, where we might see price start to turn and go down or start to turn and go back up. We must combine oscillators, indicators, forward-looking techniques together to anticipate price movement on a chart. If you are trading stocks, there are things outside of the chart that directly impact your price. 39% of your stock's move is directly correlated to what the index is doing. 41% of your stock's move is directly correlated to the sector and industry. So things outside of the chart, indexes, sector, and industry, must also play a part in what you anticipate price to do based off of your data collection and your statistics. Furthermore, there are other things that we can look at, such as the advancing issues over declining issues, to find out whether we should be looking for certain chart patterns, bottoming patterns versus topping patterns. Now you can change this to a smaller time frame or a larger time frame. We can use things like the trend, $TRAN, which is a short-term traders index, helping us identify whether we should be looking for reversal patterns or consolidation patterns. We have things like the tick for intraday trading, showing when we should be looking for topping patterns or when we should look for bottoming patterns. We have other things like whether we're inside or outside the prior day's trading range. These are all pieces of information that help us evaluate whether we need to be engaged in the market or whether to be sitting aside and waiting for a better setup, okay? Smaller time frames, we use the same pieces of information. Here we have the Dow 144 tick. We identified as A being a 1618 extension of the prior swing, B a 113 extension of the prior swing, C approximately the same level as X, or a 618% retracement level, okay? All setting this up to give us some information on where we could anticipate point D to come into play, just by the measurements, okay? But we also have a support level coming down into that range where we have a projected level of D at the 1618 extension of Y to X, okay? Systematically, you need to evaluate your chart pattern and look at the things not only on the chart, but things outside of the chart. This is what experienced traders do very, very quickly and very intuitively, saying, oh, there's a shape, there's a pattern, okay? The thing that enhances a novice trader's experience and the ability to be more consistent is if they take the time and start to study price behavior. They begin to feel that, hey, you know, when things are going good, this is what normal behavior is on XYZ stock. We may include some other studies to help us identify behavior by measuring gaps, a gap up or a gap down on any product. We may find that, hey, when Caterpillar has a gap up of X amount of points, the gap fills 80% of the time within the first 15 to 30 minutes. If Caterpillar has a big gap, that gap doesn't fill for several days, Okay, but those are pieces of information that if you have in your tool bag, you can anticipate those behaviors. We may even do the study of number of bars up and number of bars down. We may also identify that at the turning points, the peaks and valleys above and below the 50 moving average, sometimes we have many candles. And sometimes we just have a few candles, like 3 or 4 candles on the turning point. Okay? What does it mean when we have more than 3 candles at a turning point? It's at a place where we might have a demand or a supply level. Okay? Typically, when we're looking at a demand or a supply level, there's a good example over here. Is the reversal points at liftoff are generally about 3 candles. Okay? When we're forming that base, they tend to be more than 5 candles in the same general area. Okay? So when we start seeing at a high point or a low point, places where we have a lot of consolidation, these levels tend to be places where we will look for price to retest and then proceed. Okay? So as we kind of look at a couple of other patterns and shapes, let's just see if we can find another setup here. I like looking at the higher swing lows because they tend to be a little bit easier to spot at the reversals. Well, let's just ask you guys, do you have a stock pick that you would like to look at to where we can evaluate what we're talking about here? And then we'll kind of wrap up the session. I don't want to make this sound like it's redundant, but the information you're collecting is so vitally important to your confidence in a trade, confidence in using the stops, confidence in using projections.
We got 3 stocks, CLAC, K-L-A-C, Apple, and Hecla, H-L.
Okay, so let's go KLAC. What time frame are they looking at those on?
Didn't say. You might as well do the daily. Daily or 30-minute.
Okay, so let's go to the daily chart and look at KLAC. Okay, one important thing you might consider doing is eliminating as much noise on your chart as possible when you are looking at a setup, okay, or looking at analyzing price. One, you might eliminate many of the moving averages because we're only looking for one moving average to identify a price behavior. So let's go down and let's insert analysis technique, and let's just put a moving average, one line on here. And I'll make it a little more thick, and we'll change the inputs to a 50. Okay. Now, some folks can see right through all the colors. But again, the red and green candles are noise. So let's tune down the noise. Let's go to Format Symbol, under Style. Let's just kind of change these candles kind of to a neutral color, something that's not going to be too overwhelming. Okay, notice how the chart kind of quiets down. When we have the red and green candles on there, we start drifting into how I'm going to trade this. We don't want to go into the trading mode. The trading mode has specific setups, specific entries, and risk management and projection. Here, the information gathering mode is what is most important here. So let's just analyze KLAC on a daily chart and kind of do a shortened version of it. Let's grab the last 3 to 5 swings above and below the 50 moving average. And let's start anticipating what the right side of the chart may do based on the averages that we and the information that we collect. Now there's often questions, well, why didn't you use that swing? That's a very valid swing. It is a valid swing, but not on this time frame. Okay? On this time frame, I need to have the peaks and valleys above and below the 50 moving average, and I need a way to eliminate the different noises in the market. Okay? We have enough distractions, enough fractals and behavior on other time frames, but the time frame in which we are trading, we need to not have any of that noise. Okay? So let's anticipate what this next swing up, where we should look for a reversal point on average. So let's take this average swing up. Oh, I don't want parallel, I want a label. That swing up was $6.50. This swing up, $23.98. And this swing up, $5.84. Okay, so let's go find my calculator again. 5.84 plus 23.98 plus $6.50. $36.32. We're going to divide that by 3. So the average upswing is about $12. Okay. Multiply that by 0.08 or 0.80.
Should be 0.8.
Okay, so 0.8. So we're looking, let's see, we had $12 swing up. So let's just grab another line.
Should be about 9.
About 9, okay. Okay, so we had a 88% chance that we were going to get 9 points on average for the move up. Okay. 12 points is the actual. Okay, so if we kind of measure out where about 12 is, and we start correlating where the 12 is with maybe other levels that might be support or resistance, might be supply levels. Okay, you know, when you're looking at your supply, you're going to be looking for where price had a nice move down from these levels. Okay, so we have that range. So with KLAC on a daily chart, am I looking to go long here? We have a lot of different pieces of information, and for me to start anticipating that we're in an uptrend, that I need to get long on this because I think that price is going to go higher, might be a dangerous move. Okay? So let's go back and find out, well, we're near the end of this move up. It might go up a little bit tomorrow or so. But what I want to find out is, what is my next move down? Okay, so I'll take this move down. Let's put a label on it. We have 11 points move down, 13 points, and $4.86. Okay, so let's clear our calculator. 4.86 plus 13.7 plus 11.01 equals 29.57. We're going to multiply that by 0.8 equals 23.60. That's not right. What did I do wrong here? Let's go 11 plus 1370 plus 4.86, 29.57. Okay, so on average we're looking for a 29.57 move down, And if we get 80% of that, which is going to be about $24, okay, roughly. Hold on, I didn't divide that by 3, did I? That's what I did. Okay, so looking for about $9.85 move down. So 80% of 9.85. What are we looking at?
About 8.
Okay, about $8. Okay. So if we're looking for an $8 move down from this point, we would start to project about where that $8 can come into play. So on average, we could be looking for a move back down into this area, and we want to kind of correlate that. Do we have support resistance? Do we have a Fibonacci retracement? Do we have any type of setup that would be coming into this general range? Okay. If we continue the whole move down, we might find that, hey, on average, that might make a higher swing low. Okay. Once we get this far down, get about $10 or that 9 and change, okay? So as we're using the projected or the average swing size, we're going to start looking to correlate it with fib retracements, fib extensions, support resistance, demand supply levels, so on and so forth. We're going to bring everything we can to the party here to find out what the average swing down or where price may change direction.
Jeff, I just wanted to bring up something for some of the people that aren't familiar with you drawing out the fibs. You highlighted on your fibs the 78 and the 88 level as dotted red lines. Can you just explain the significance of that?
Yeah, when I use my Fibonacci extensions and retracements here, that's a good point. You can see all the different levels that I use. Now, these levels here, starting with 38, 50, 618, these are retracements. Occasionally, I do put the 23.6 on there, okay? So these are all the different levels that we use. Now, these colors are different because they're my retracement levels. Anytime that I have a swing from low to high and price comes back into the range here, this level is going to be a C point. Okay? When we see price points going below the 618 and lower, the reference point down here would be an A point. Okay? Now, the 78 and the 88.6 are favored patterns that I like to participate in. Okay? When I have a swing going from low to high on the range and price coming back down into the 78 or the 88.6% retracement, it's making a higher low. Okay? In that point, tends to be where we see reversals. So I'm using the 78.6 and 88.6 to say, hey, that's a double bottom, higher swing low. Use a 113, 127, 1618, and so on and so forth. These will tell me whether I'm looking for momentum reversals, whether I'm looking for head and shoulders reversals, whether I'm looking for V bottoms or V tops by using the other levels. Okay? The retracement levels are common when we're trending. Okay, the 23.6 is common when we have some momentum behind it. Okay, momentum behind the move. It's a shallow retracement. When we start getting deeper into the retracement levels and we break the 618, we're then not looking for a trending pattern anymore. We're starting to look for reversal patterns. So by having the Fibonacci extension and retracement levels color-coded for myself, I can quickly gauge whether I'm looking for reversal patterns at this point or whether I'm looking for trending patterns, forward-looking. Okay? So I hope that answers your question here. I color-code the lines just to help me anticipate and for teaching purposes, look for where we might find a change in trend. Okay? or a Fibonacci retracement level that will give me a specific chart pattern. Now, in later classes and later webinars and things like that, we'll start to explain the reversal patterns and so on and so forth. Okay, so for KLAC, this is a summary, just using the average swing size. We're near a range where going long may be more risky. Okay, we're nearing a range where we need to consider what the indexes are doing. Now, KLAC is let's go to research here, and let's find out what the beta is on KLAC. Now, KLAC moves a little faster than what the overall market moves. Okay, so we want to keep that in mind, that the indexes, if they start to go down, that KLAC's going to go a little bit faster. If they go up, KLAC's going to go a little faster. Okay, so we want to understand the relationship between the index and the price of the stock. Okay, we also want to take a quick look at the financial sheet and kind of look at what is the most recent quarter, what's the book value. Okay, now with the NASDAQ stock, these are typically growth companies. Let's go back and look at the highlights of KLAC. KLAC does pay out a dividend, okay? Still listed on the NASDAQ, but most of the products that you're going to see on the NASDAQ are growth-oriented, and many of them do not pay out a dividend. Once they start paying out a dividend, they tend to be more of a value type company rather than a growth company. So the expansion of price and the movements of price tend to be less. Okay, they pay you for using your money with a dividend rather than the price of the stock. Okay, the financial strength also alerts us that, hey, the most recent quarter says that, hey, $17.12 is what this stock is worth if it sold every pencil and broke up tomorrow. Okay, you can typically take that number and multiply it by 2, within the range of 2 to 4, and the price of the stock would be fairly priced. So if this was trading at $34, or if it was trading at $64, it would still be within the range that would be acceptable. Now what we're going to look for is use this information, little fundamentals, to find out how would price be overvalued or undervalued if it came down to that $35 level. Okay, or would it be just kind of within a normal range? Companies like Citigroup or Bank of America that have a ton of assets, and when they do their book value, they're very underpriced stocks at this point based on what they have, okay, and what the value of what they have is. Okay, this opens the door to let fundamental type traders come in, or fundamental analysts come in and start to upgrade or downgrade a stock's value. Okay, now the book value on a NASDAQ stock tends to run 2 to 4 times the book value. What I mean by that is when you take a NASDAQ stock, you multiply the book value by 2 or 4, and you understand that if price is within that range, it's okay. If it's above that range, it's overvalued. If it's below that range, it's undervalued. Now, analysts like to talk the market to the upside, so they like to point out that the stock is undervalued fundamentally. Okay, so they will upgrade at that point to a hold or to a buy or to aggressive buy or something like that. If the stock is overpriced based on book value, then they will come out with some downgrades, and they will come out with some recommendations to start taking some profits, or downgrade not to a sell but to a hold, or so on and so forth. So by understanding the fundamentals as well as the technicals, you can start to see how and when people may come in to influence the price. Now, 80% of your stock's move has nothing to do with the stock itself, so we need to look at the things outside of the chart, such as the fundamentals, such as the indexes, such as sector and industry and swing sizes and so on and so forth, bringing all that information together. When we find a price level where most of our analysis comes together, it becomes self-fulfilling because we're looking at the MACD guys, the stochastic guys, the fundamental girls, and the Fibonacci guys and demand supply people. Everybody is coming together at one spot. It becomes self-fulfilling. It's not about one technique, one strategy. It's about understanding them all and looking for where they all are coming together, thinking the same thing is going to happen. If everybody's behind it, the fundamental guys, the technical guys, the hedge funds, money managers, so on and so forth, when they're all thinking that this is a good place to enter a trade, they will definitely show up to participate. Okay, what was the other stock that we had to?
HL and Apple. Hecla for HL and Apple.
Let's do HL. I'm going to reference the daily chart as well, again here. Again, we're going to take the swings above and below a 50 moving average. And I'll usually find the most obvious one for myself as a starting point. And these ones here that just kind of hug the 50 moving average, I tend to tune them out for this time period. I think I'll capture that one. Now, you have to decide what is a window for you, a nice price away from that 50 moving average, and what is acceptable to you. Okay? For me, I like to have a nice little gap between price and the 50 moving average. If I do not, then I tend to tune that noise out. Okay? So as I look at this last swing to the upside, oh, nice. That was a lower high than a prior high, so that would capture my attention for a moment, and I'd grab my measuring stick and find out, well, let's see, does that line up with a 78 or an 88.6? Okay. Then I would use that leg down, which is my XY leg. I would start to project out where the end of the move would be at the 1618 or a 224. Okay. Just from some of the price patterns, we'll talk about reversal patterns later on. But let's anticipate what is our next swing. I mean, we're in a downtrend, right? The swing was from above the 50 moving average to the lowest low below. So as we're looking for a trade, we're now going to start anticipating what is the next move up at this point. We're also going to anticipate how much more room do we have to the downside. So we're starting to look and project, well, we have this much more room to the downside. If we start to reverse and go back up, we'll start looking for a swing back up. Okay. So as I look at this, I'll take this last swing. Let's put a label on it here. $7. I'll have this swing up. $2.77. $1.74. 1.74, 2.77, and 7.02. Okay, $11.53. Divide that by 3. We'll get about $3.84. Okay, so if $3.84 is what we're looking for the average swing back to the upside. Okay, we look to capture 80% of that swing. Once it's gone more than 80% of the average swing, we're not going to keep trying to take breakouts to anticipate where price may go. Now this is, as I referenced breakouts, right here would be a place that many traders would start to jump in only to see the price was just making its average swing up, and then maybe experience the next swing down. Okay? So by using the average swing size, we can say, well, hey, that looks like a good breakout, but when I measure the average swing size, this thing has almost run its course on average for the daily time frame. Okay? So for HL, Hecla Mining, the move up here on average, let's just say this is $4. 80% of $4 would be roughly what, about $3? No, it's 75. About 3 and change. Okay. So we find out where that 80% level is, and we might even find that we have a supply level where traders stepped in before. And we just start using that information. Okay. The information says, hey, we still have a little bit of room to go to the upside here. Do I jump in here? Well, no, you have to go down to a smaller time frame and splice your way into it. So by the daily chart, let's drop down to maybe a 30-minute chart and find out if we have an opportunity, or should we wait for that opportunity. Wow, look at that double bottom down here. That one's already played out, okay, and that's a fractal. You'd have to probably go down to a 5-minute chart to get everything to measure out. But on this 30-minute chart, we have a swing from below the 50 to above the 50. Okay. What we're looking for is a place to splice in so we can play this up. So we need maybe a pullback to make a higher swing low, a reversal pattern. Because what we're anticipating on the higher time frame is we do go higher up into that about the $7.78, $8 range. So what is the pattern that we're looking for to help us splice into that? Okay. It's all the same method, all the same approach, no matter what time frame or tick frame. You're collecting pieces of information, collecting data to analyze price behavior. Okay. So let's jump out and let's look at Apple here. APL.
Jeff, while you're doing that, there was another question here, 2 questions. How do you place the angle of the downline? And the second question was, can you have multiple A's in a row?
Yes. The angle of the downswings or the projections, let's see, let's go back to HL. I don't necessarily know the slope. What I'm eyeballing is what was the prior angles. Now, if you have the ability to measure the slope, you can use that information as well. If you take the average, what is the average slope of this stock on a daily chart? Okay, and what you're doing is gathering that information from each one of the swings that have already completed. So when you're seeing the slope of my chart going to the right side over here, it's really based off of what I'm seeing as the slope of the prior swings. Okay, only because I don't have the measuring tool to identify what that slope is on this particular time frame here. Let's see if I can. But if you have the ability to do that measuring, you can find out what that slope is and add that into the behavior in which you're looking for that price to move. Okay. Was there one other question? Multiple A points. If we're in a very strong move to the downside, you could have multiple A points. Let's just take this HL as an example. Let's clean up some of the other swings here. By looking at this swing here from below the 50 to above the 50, we might see the price came down to a 113 extension. Okay, came down, bam. That would have given us an A point. Okay. Now, if we were looking for a price to go higher and we stayed with the trade, we might have been stopped out at this A point. As we're looking for another A point, here's the next one here at 24. And sometimes you may get into a situation where you don't have a window above the 50 moving average and prices keeps going lower and lower and lower. And you may have several points that you anticipate as an A point. But once you get down to the 224 extension and price retraces, you would eliminate this one because it's no longer good information for you. You'd be looking for this level here to enter that trade off of a reversal pattern of sweat. Apple, daily chart. Let's look at the last few swings above and below the 50 moving average. High point, low point. Now, don't get carried away with trying to anticipate a trade on this, okay? At this point, it is only information. The information does not make your trade. The trade setup makes your trade, okay? So as we're looking at these last few swings on Apple, we're going to try to anticipate what is the average upswing potential here. What is the average downswing potential? The average downswing and why price may have stopped here, let's just look at that first. I have $44.39 swing down. $44.39 swing down. $42. Okay. Oops. Sorry, my phone going off. Okay. So if we're looking at the average, let's just say it's $43. Okay, 42, 44. So it's kind of ballparking it. So what was this average swing down? 69. Okay. Did we accomplish 88% of the average swing? We did. Did we accomplish the full swing? We did. Okay. So once price started going beyond the average swing size, we started looking at where we might have a potential reversal pattern. Okay. And where price may change direction and go back up. Now let's look at the swings to the upside based on the averages here. 112-point move up there. 34 and 128. Where's our calculator? 128 plus 34 plus 112 plus 274 divided by 3, 91 points. Okay. So the next move up we may be looking for there's a possibility of that being about 91 points. Okay. Now this is not 100%, and I have to go and evaluate, is Apple overvalued at this point? Let's bring some fundamental guys in here. Right click, create, research, financial strength. Well, actually, let's go to the highlights first. Is Apple a growth or value company first? If it's a growth company and it still looks like it's growing here, then we have a multiple of 2 to 4 times the book value. Okay, So if we take all of Apple's holdings and then in its assets and things and sell it today, that would be the book value. So the book value for the most recent quarter was $74.81. So if we took the larger multiple, 74 times 4, we would see that we have, let's see, we got 16. We have a book value of about, or a good price for Apple right now would be $296 a share. But we're trading at 408. So is it possible that the analysts could come out and start to downsize positions? Could they downgrade Apple, and could they put some things out there that might make the price go lower? Okay. We just want to anticipate the behavior. This is just an average where we expect price to go up to. Now, if I look at, I'm looking for a topping pattern potential, I would be pulling from low to high and look to see if I had a fib level along the way. As far as extensions, I would look to see if I have a level where we might find a lower swing high at the 78 or the 88.6. Okay. I'm going to start digging through and finding, is there anything along the way as price starts to move up here that may cause us to change direction. So Apple on a daily chart is right at the 78.6% retracement. Okay. It is possible that that might be a resistance level. If it trades through this level, we might get to the next level. We have a level where traders sold off Apple before, maybe because of some news or some things like that, and maybe they were long at this point and they have the opportunity to get out at break even here. Okay. We have Apple coming up with earnings and things like that. Maybe that'll be that last hurrah where price runs up into one of these other levels. Okay. On this time frame, the average is Apple should make it up into these ranges. Okay. But if it holds these levels, then I have another measurement, and I would start to analyze and do the same process and procedures going forward. Swings above and below a mean, whether it's a 50 moving average or a 20 moving average, it doesn't matter. Okay. Find what works best for your style. So that's my story. I got a little redundant on a few things there, but it's really important that we understand the relationship of price on the product we are trading. And the more that we understand the relationship and how it moves, the more prepared we are when things start to get a little crazy. We also can use the different anomalies in the market to help us anticipate when something's just not right. Okay? I'll turn the mic back over to you, Mr. Ron, and